Hello and welcome to the second module of IAS number 7. In module number 2, we are going to discuss the classification of the cash flows. Remember, in the first module, we discussed that cash flows in the statement will be classified into one of the three types of activities. Number 1, operating activities. Number 2, investing activities. And number 3, financing activities. And it should be in the same order. Now let's start with the first type of activities, which is operating activities, to define these operating activities and give some examples. Operating activities is all about the core revenue generating activities of the entity. These are the day-to-day business operations that directly contribute to its profitability. Operating cash flows arise from transactions and events that affect the determination of the net profit or loss. So this means that it relates to the main business, main operations, main activities of the entity. Some examples for the operating activities are as follows. Cash received from customers. So if the company is going to sell a product or provide a service in the core business, so the cash received from the customers will be considered as part of the operating activities. Number 2, cash paid to the suppliers for goods and services that the company acquire or receive. And number 3, the cash paid to the employees for wages, salaries, and we can list several more examples such as payment for rent, payment for tax, and payment for utilities as well. Maintenance expenses as well. All of these are related to the operating activities. After listing these examples and definition of the operating activities, you might recognize that operating activities are crucial. Why? Because they reflect the cash generated or used in the entity's primary business operations. And this is very important for every entity to recognize that the cash inflow, which is the cash received from the operating activities, is more than the cash outflow that they are paying for the operating activities. So the net cash flow for operating activities will be positive. If the inflow is higher than the outflow, so the net cash flow from this group of activities will be positive. And this is very crucial for every organization, for every entity to make sure in order to survive and running the operations in future. Now, let's discuss a tricky point related to the treatment of the interest and dividend. Interest and dividends paid or received can be classified as operating, investing, and financing activities, depending on the nature of the entity's operation. I want to tackle this topic from two perspectives. Number 1, the practice, and number 2, the IFRS exams. Now let's start with the practice. The interest paid on loans is classified as operating activities because it is part of the cost of obtaining the financial resources for operating activities. Whereas interest received is usually classified as investing activities because it involves returns on the investments in other entities. Finally, if the company is going to pay dividends to the shareholders, so this dividend that's paid to the shareholders are considered financing activities as they involve the distribution of profit to the entity's owners. So this is in practice. And it's worthy to mention that we have one new accounting standard which is issued in 2025. It's called IFRS 18. You will find a separate section for this standard in our course. This standard, which is IFRS 18, will be effectively applied in 2027, the beginning of the year 2027. And this accounting standard will have some changes to what we are discussing here regarding the treatment of the interest and dividends. So the treatment of the interest and dividends that I'm explaining here in this section will be effectively applied until 2027. And from 2027, we are going to apply IFRS 18, which will have different classification for interest and dividends. So the discussion that I have provided before is related to the practice and what companies are doing in real life. Now, when it comes to the IFRS exams, if you are a learner or a student and who are going to enroll in the diploma exam for IFRS, for example, so I want to highlight the following. IAS number 7 gives companies the option to classify interest and dividends, whether paid or received, as operating activities. So this is very important that you have this option at your hand for both interest and dividends, received or paid, but you have the option to classify these as operating activities. So in brief, if we need to set a rule, we can say that interest and dividend received can be classified as investing activities, and the companies has an option to classify them as operating activities. And on the other hand, interest and dividends paid can be classified as financing activities, but companies also has the option to classify them as operating activities. Now, let's move to the second type of activities, which is related to the investing activities. Investing activities involve the acquisition and disposal. So look at these two words. Acquisition, meaning that the company is going to purchase assets, long-term assets, such as investments or such as machine and equipment, for example. Then disposal, the company is going to sell one of these assets, for example. So any cash flow related to the acquisition or disposal of long-term assets and other investments will be considered as investing activities. These activities are essential for the entity's growth and the strategic development, because if the company would like to expand in future, so it depends on their capability to acquire long-term assets such as machinery or equipment and so on. So this is very crucial when it comes to the entity's growth and strategic development. Some examples of the investing activities include cash payment for the purchase of property, plant, and equipment, as I explained. Cash received from the sale of the investments in other entities. If you have share in another entities, for example, 20%, 30% share in another entities, so you are going to sell it, you are going to receive cash. So this is cash related to the investing activities. Finally, I can say an cash payment for the acquisition of securities. So if you are going to acquire security, if you are going to purchase bond, if you are going to purchase shares of other entities, so the cash that you pay to acquire these securities will be considered as a cash outflow and related to the investing activities. Now, as you can see, investing activities represent the deployment of the resources for long-term value creation, like property, machinery, equipment, and intangible assets, and investment properties, and also financial assets that the company invests in. All of this will be related to the investing activities. Now come to the treatment of the cash flow from acquiring and disposing of long-term assets. Cash outflow, which is a minus because you are going to pay for acquiring these long-term assets, such as buying a new facility, are categorized as investing activities. And the cash inflow that you receive from selling long-term assets, such as selling a machinery, are also classified as investing activities. Now, let's move to the third type of activities, which is the last one, financing activities. Financing activities involve the entity capital structure, the sources of funds, and how it funds its operation. These activities include transactions with the entity's owners that provide capital or equity, and also creditors who are providing debt or loans to the entities. Examples for this category might include cash received from issuing shares or other equity instruments when it comes to increasing the capital, so you are getting contributions from owners, and also cash paid to repurchase the entity's own shares, which is considered or defined as treasury share or treasury stock, and also cash received from issuing or borrowing money, such as loans or bonds. Finally, I can say that cash paid for the repayment of borrowing is also considered as a financing activities because it impacted the capital structure, as I explained before. In brief, financing activities highlight the entity's capital structure and its relationship with owners and creditors. Now, let's see the treatment of the cash flow from issuing or repurchasing own capital and debts. If your entity received cash from issuing new shares, so this is a financing activity. And if your entity paid cash to repurchase the entity's own share, it's also a financing activity. This one we defined before as treasury stock. The company is going to purchase its share or its stock from the stock market. So this is called treasury stock or treasury shares, and this one will be defined as financing activity as well. Also, cash flow related to the borrowing or repayment of debts are also classified as financing activities. At the end of this module, I would like to highlight that understanding the classification of cash flow into operating activities, investing activities, and financing activities is fundamental to interpreting the company's financial health. In the next modules, we are going to delve deeper into the presentation of this cash flow on the statement of the cash flow statement and explore practical examples for comprehensive understanding. Stay tuned.